Joining me right now with more reaction, we have Bullseye Brief publisher and founder Adam Johnson, as well as our very own Kristina Partsinevelos and Moody's chief economist Mark Zandi. I'm going to go to you first, Mark. It's been a while. Good to see you.
Hi, Trish. It's good to see you. Yeah, it's been a while.
So they're staying the course here. Are they going to be able to continue on this path with 2 more rate hikes, given the concerns about trade right now, which they did not fully articulate?
Yeah, they have a script. 2 rate hikes this year, 2 more rate hikes this year, 3 or 4 next year, quarter point each time, with unemployment low and falling, inflation close to target, stock market doing as well as it is. Yeah, I think they're going to stick to that script. Trade could derail them, but, you know, it'd have to go take a pretty dark path here for them to actually change the script that they're on.
Mark, is it the right move? Do they need to be raising rates in this environment, given that we are seeing a lot of sort of promising numbers on the economic front?
Yeah, absolutely. I mean, you know, given all the fiscal stimulus in train, so these are the tax cuts, deficit finance tax cuts, deficit finance increases in government spending, the growth is going to be strong. It's going to push unemployment into the low 3s. We've only been there 2 other times in history, in the middle of World War II and the Korean War. So, yeah, I think they need to normalize interest rates pretty quickly here.
I love that. That would be great. Mark, stay with us. I've got Kristina and Adam here as well. I mean, if we get down into the 3s,
it's fantastic.
It is fantastic. So,
well, I would call today's comment from the FOMC Goldilocks with a kicker. In other words, they said that the risks to growth and inflation right now are balanced. That's good. That's the Goldilocks part. And you're getting business investment. That's the kicker. And that's what we like to see, because if businesses are investing in plants and equipment, they're also probably hiring. And I think that's Mark's point, that, you know, you push unemployment way down to the low 3s. Amazing.
Okay. So when are wages going up? I mean, that's my question.
Exactly. That's a big point. So I want to see this wage growth. I know we're getting our jobs numbers at the end of the week, but that was something, I think it was maybe, a few months ago, we sat here and discussed exactly that the lack of capital expenditures from all of these businesses, they're just not reinvesting. So this is great news that, that Edward just announced right now that they are increasing it. I was looking to hear more comments about if there was going to be a for now, any type of added change in the language for their forward guidance. It seems like nothing's really changed so far, as we've seen.
Exactly. To the script.
Sticking to the script. And was that done intentionally because of the president and his tweets against the Fed?
You know, I don't know.
The script is pretty clear at this point. It's 2 more hikes, you know, once we get into the fall, September, December. That's the script. They're sticking to it. And I think that's what the market wants to hear.
All right. Kristina brings up a good point. I mean, people have wanted the president has gone into sort of uncharted territory there in terms of saying that he thinks the Fed should keep rates as low as possible. I mean, he likes cheap money. Certainly he made a career, right, out of borrowing and investing and benefiting from that arbitrage. But Mark Zandi, to have a president really, you know, articulate that and for the Fed to actually do what the president wants, you know, that's kind of the Chinese wall that has always been respected. And I assume Jay Powell will continue to do so.
Yeah, I mean, the president's making a big mistake here. I mean, Fed independence is a cornerstone of a well-functioning financial market and economy. You don't want to mess with that. And he's got the economics wrong anyway. So if the Fed doesn't raise rates consistent with what's going on with the economy, long-term interest rates will rise. And that's even worse for the economy.
Okay.
So, yeah,
I'd also make the point.
This is a bad path.
I'd also make the point, and it's one that Adam has heard over and over and over again, as long as we've known each other, that you cannot be operating in an environment without the threat of higher interest rates in the future and expect any kind of growth. In other words, it's healthy. It's good that we're anticipating
rates are going up because of growth. Right. Right? That's the point.
And part of, you know, growth is the anticipation that things are going to get better.
Yeah.
So we should expect that we're not going to be here, you know, in these low interest rates environment forever. The problem during the Obama years was, you know, you had no fiscal policy, and the monetary policy was so accommodative that people felt like they didn't need to buy anything today because they could do it tomorrow.
I'll make it easier for you, Trish. You had nothing during the Obama administration other than apologies, and that apology tour is over.
I want to just point, we're talking about raising interest rates, and that's already playing a role on the housing market. We're seeing demand drop, the biggest drop we've seen in 2 years, just in the month of June. So housing demand fell 9.6%. And I actually want to circle back to wage growth, because that's something that's still not climbing high. There was a longer report that I got hold of yesterday, and it came from the Roosevelt Group. And they talked about two researchers, and they specifically discussed buybacks as being the reason we're seeing low productivity and low wage growth. And they had a number, and this is really interesting. If anybody that's listening, and you're laughing right now, but if you worked at Lowe's, CVS, or Home Depot, had there not been buybacks at those companies, your workers or the workers at those companies could have seen a raise of $18,000 a year.
Well, this gets to a much bigger problem, and I'm going to go to Mark on this one, because I'm concerned that the point we're now in is a society where companies are so publicly traded and they rely on those public markets, and we are in a global economy. There is a benefit to those with capital that workers, frankly, and labor does not have. And so it's out of whack right now, right? I mean, if you are the one that's putting the capital up and taking that chance and that risk, you should be compensated for it. But the problem is that there's nothing for the labor right now that, frankly, is also taking a risk. To use an economic term, Mark, if you're working at Home Depot, that's an opportunity cost of not working somewhere else or starting your own business. So how do we get back to some kind of normal where labor is fairly rewarded?
Well, I think that's happening. I mean, I would argue with the facts. I mean, I think wage growth is accelerating. I mean, if you go back 3-4 years ago, wage growth was 1.5% to 2% per annum. Now it's 2.5% to 3%, and closing in on 3%. And with unemployment going into the low 3s, we're going to be well over 3% by, you asked me back next year, we'll be well over 3%. So it's already starting to happen. It's becoming an employee's market. But with regard to the buybacks, the share repurchases, that's symptomatic of a problem businesses have figuring out what to invest in, right? Mm-hmm. I mean, they're getting all this cash because of the lower tax rates. They can invest it. They can hire people with it. They can give dividends, or they can do share repurchase. And so far, the investment's back a little bit. Most of it's going into share repurchase and dividend payouts. And that's symptomatic of an economy trying to figure out what to do with all the cash. That's not great news for long-term growth.